March 2025. A major solar manufacturer in Germany quietly cancels all orders for the next quarter. This isn't a bankruptcy, it is a preservation of capital. They simply cannot source the silver paste required to build their high-efficiency N-type cells. Across the Atlantic, a defense contractor in Virginia adds massive quantities of silver to their strategic reserve, bypassing the open market entirely. They aren't buying futures contracts. They are taking physical delivery of 1,000-ounce industrial bars directly from refineries. 3 Asian refineries stop accepting new contracts. They declare force majeure on their export obligations, citing domestic priority mandates. And in London, the world's oldest bullion dealer implements purchase limits for the first time in 340 years. This isn't happening tomorrow. This is the scenario that is being engineered right now. The signals are subtle, buried in technical reports and obscure import data, but they are flashing red for anyone paying attention. If you don't understand what these signals mean, you are about to watch the largest industrial commodity crisis of the 21st century unfold in real time. Welcome back to the reality of today. In the next 15 minutes, I'm going to show you the 3-phase lockdown pattern that precedes every critical resource crisis in history. We saw it with oil in 1973. We saw it with rare earths in 2010. And now, the data is screaming that it is happening with silver. But the difference this time? There is no substitute. There is no workaround. When this lockdown completes, entire industries stop. And if you are holding paper currency instead of physical assets, your purchasing power is about to be trapped in a burning building with no exit. To understand where we are, you have to understand the playbook. Governments don't announce resource shortages, they manage them. They follow a specific 3-step sequence to secure their own survival before the public realizes what's happening. Phase 1 is silent accumulation. This is where smart money, sovereign states, and megacorporations drains the global supply without spiking the price. They buy in the shadows. They utilize off-market transactions and sovereign wealth funds to mask their footprints. Phase 2 is fragmentation. This is when the global free market breaks apart into regional fortresses. Export bans, tariffs, and national security restrictions kick in. Nations stop trading and start hoarding. And Phase 3, that's price controls and rationing. That is the end game. That is when you, the retail buyer, get locked out. Most analysts think we are years away from this, but I've pulled the data that the mainstream media is ignoring. We aren't years away. Phase 1 is already finished. We are deep into Phase 2, and today I'm going to prove it to you. Let's look at the silent accumulation that has already occurred. In late 2023, China stopped reporting detailed silver import data. For years, the Shanghai Gold Exchange has been draining physical inventory from the West. Why does that matter? Because China consumes roughly 20% of the global silver supply. They control over 80% of the global solar panel manufacturing capacity. They know exactly how much metal is needed to meet their 2030 energy targets. When the world's largest consumer goes dark on statistics, they aren't stopping consumption. They are hiding accumulation. They are moving the asset from commercial inventory to strategic state reserve, effectively removing it from the global ledger. Then look at India. In 2024, silver imports hit 38-year highs. The media tells you this is for jewelry and festivals. They paint a picture of traditional cultural buying. That is a lie. The Indian government recently reclassified precious metals alongside military assets in their strategic planning. They are building gigafactories for photovoltaics and electronics. They know the supply crunch is coming. You don't do that for ankle bracelets. You do that for a strategic industrial weapon. And here is the part that should terrify you. While the East is hoarding, the United States, the country that prints the world's reserve currency, has 0 strategic silver reserve. None. We sold the last of our stockpiles between 2005 and 2015. The Defense Logistics Agency, which once held massive stockpiles for wartime needs, liquidated everything to mint coins and suppress prices. We bet on the just-in-time global market. We bet that we could always print dollars and buy what we need. They bet on physical control. They bet that in a crisis, he who holds the gold and the silver makes the rules. Think about that. The metal required for every Tomahawk missile, every solar panel, and every piece of advanced electronics. We have to buy it from the very countries that are currently locking the doors. If you want to stay ahead of these macro trends that impact your wallet, take a second to subscribe. We track the data the news ignores. Don't get left behind. It's not just governments. The corporate insiders saw this coming first. In 2024, reports surfaced of major EV and solar manufacturers like Tesla and First Solar securing long-term supply contracts. They realized that relying on the COMEX spot market was a liability. They stopped buying from the COMEX or the London bullion market. They went directly to the mines. They signed 5 to 7 year offtake agreements. This means the silver coming out of the ground is sold before it ever sees a vault. Why? Because industrial giants don't care about the price of silver. A tiny sliver of silver goes into a phone or a car. It is a fractional cost of the final product. If silver goes from $30 to $100, it barely affects the cost of a $50,000 Tesla. But if they have no silver, the assembly line stops. The company dies. This is inelastic demand. They will pay any price. But more importantly, they are securing physical access before the shortage becomes public news. The smart money is already positioned. They have built their moats. The question is, are you? This brings us to phase 2, fragmentation. This is where the global market breaks. It starts with excuses: environmental protection, labor laws, national security. Mexico, the world's largest silver producer, has been tightening mining regulations and floating the idea of export quotas. The government is looking at its mineral wealth and realizing that exporting raw resources for depreciating dollars is a losing trade. Peru is doing the same. We are seeing a wave of resource nationalism across Latin America. But look at the smaller signals, the cracks in the banking system. In early 2025, reports emerged of banks in South Korea and China restricting retail silver sales, not because they didn't want the business, but because they couldn't source the metal. When banks with unlimited fiat capital cannot secure physical metal, the global price you see on your screen is a lie. We are seeing a bifurcated market. The paper price on the stock market says one thing. The street price to get metal in your hand says another. This is the hallmark of phase 2. The supply chain is fracturing and the metal is staying within domestic borders. We have seen this movie before. In 1973, it wasn't that the world ran out of oil. It was that the supply was weaponized politically. OPEC realized their leverage and shut the tap. Prices didn't just rise, the system broke. Gas stations had no fuel. Strategic reserves had to be invented overnight. In 1980, the Hunt brothers exposed just how scarce silver really is. They cornered the market, buying up physical delivery contracts until the vaults were nearly empty. The establishment panicked. The Federal Reserve and the exchanges coordinated to stop them. The exchanges changed the rules. They increased margin requirements. They banned buy orders. They declared liquidation only. They crashed the paper price to save the banks. Or look at palladium in 2001. Russia delayed shipments due to a bureaucratic dispute. The price went vertical. Ford Motor Company panicked and bought at the absolute top to keep their production lines running. But here is the lesson. Traders holding paper palladium contracts on the futures exchange didn't get metal. They got cash settled. They were forced to take a check for a devalued currency, while the industries that needed the metal scrambled for physical inventory. History tells us one thing clearly. When the shortage hits, the rules change. Paper contracts are torn up. Only physical possession matters. And that leads us to the flashing red warning light right now. The COMEX, the primary exchange for silver futures in the US, is being drained. Registered inventories, that's the metal actually available for immediate delivery, have plummeted by over 70% since 2021. We are sitting at under 40 million ounces in the registered category. Let me put that in perspective. Global industrial demand is over 1 billion ounces a year. That means the available inventory on the world's most important exchange covers less than 3 weeks of global consumption. If a single major tech company decided to hedge their supply chain and take delivery, the exchange would default. Yet, for every ounce of physical silver in that vault, there are roughly 100 ounces of paper silver traded. This is the rehypothecation trap. The same ounce of silver is sold to 100 different investors. Claims on metal that doesn't exist. When phase 3 activates, when the panic buying starts, that paper market creates a short squeeze that will make GameStop look like a lemonade stand. Now, the skeptics will say, price will fix it. If silver goes up, we'll just mine more. Wrong. This is the geology trap. 70% of silver comes as a byproduct of mining-based metals like zinc, lead, and copper. Primary silver mines are rare. Most silver is found by accident while digging for other things. You cannot just mine more silver, you have to mine more zinc. If the global economy slows down and we need less zinc for construction, we get less silver, exactly when we need more. And we need more. Governments have legally mandated the energy transition. The Green New Deal, the Paris Accords, these aren't suggestions, they are laws. They require billions of solar panels. And solar technology is evolving to use more silver, not less, to achieve higher efficiency. Solar panels require silver paste. There is no element on the periodic table that conducts electricity as efficiently as silver. This creates the perfect storm. Mandated demand meets capped supply. It is an economic vice closing in on the market, and there is no escape hatch. So, what happens when phase 3 fully kicks in? Price discovery fails. The link between the spot price and reality snaps. You will check the spot price on your phone, and it might say $50. But try to buy a coin. The dealer will say, sold out. Or the premium will be $100 over spot. Your ETF shares? They will send you a letter stating that due to market irregularities, they are settling your position in cash. This is the force majeure clause hidden in the prospectus you didn't read. You get dollars that are rapidly losing value, while the asset you thought you owned becomes unobtainable. The window to act is not when the headline breaks. It's now. When the crowd panics, you are already too late. You will be competing with Apple, Samsung, and the US military for the same ounces. I'm not telling you this to scare you. I'm telling you this because pattern recognition is the only way to protect your wealth in a failing system. The lockdown has begun. Governments are hoarding. Industry is bypassing the market. Don't take my word for it. Check the comics data. Look at the export restrictions. The evidence is public, but the narrative is silent. If you want to survive the wealth transfer that is coming, you need to be prepared before the masses wake up. Subscribe and turn on notifications, because the next update might be the one that determines if you're holding real value, or just paper promises. Watch this video next to understand exactly how to secure physical assets without getting ripped off by premiums.